right, let's unlock this whole world of exchange-traded funds. ETFs, we're diving deep into what they are and why they're so popular. And, of course, how you can use them to, maybe make your investments a little smoother. Our guide for this deep dive is this explainer we found called What is an ETF and How to Invest in One? So get ready, because we're about to discover how ETFs can, well, they can make investing feel less like a puzzle and more like a game. A game you can win.
That's the beauty of ETFs,
Yeah.
They really can level the playing field.
I like leveling up, so let's get right to it. What is an ETF?
You can think of it like a collection of investments,
Yeah.
all bundled together, right?
Huh.
So instead of, painstakingly picking stocks one by one, you're buying into this basket that could have stocks, bonds, even gold.
One-stop shopping for your portfolio.
Exactly. And the important thing is this basket isn't just sitting there. It's traded on the stock market, just like any company's stock would be. That's the exchange-traded part, and that's what makes them easy to buy and sell.
Makes them convenient. But why are they such a game changer? I keep hearing about diversification.
Okay, so let's say you buy an ETF that's based on the S&P 500. With just that one purchase, you instantly become a part owner in 500 of the biggest companies in the U.S. across all kinds of industries. That's what ETFs do. They spread your risk, just like a pro would.
So instead of all your eggs in one basket, they're spread across hundreds of companies. What if one company tanks?
Well, think about the dot-com bubble bursting back in the early 2000s. All those investors who had all their money in just tech stocks, they lost big. But those who had diversified their portfolios, maybe with an S&P 500 ETF, they were able to weather the storm much better.
It's like insurance for your portfolio. It protects you when things go bad. What else makes ETFs so great?
Well, they're really cost-effective, especially compared to something like mutual funds. It comes down to these expense ratios.
Expense ratios. Is this where it starts to get complicated?
No, not at all. Think of it this way. For every $10,000 you invest, you're paying a small fee every year, like $5. That's a 0.05% expense ratio. Now, ETFs typically have much lower expense ratios than mutual funds, often a fraction of a percent. So more of your money is working for you, not being eaten up by fees.
Like getting a discount on your investing. Love it. The source also mentions that ETFs are highly liquid. Does that mean I can make a smoothie out of them?
Haha, not quite. Liquidity in investing just means you can buy or sell your shares anytime the market is open. It's like having cash on hand, but with the potential for growth.
More control and flexibility, not like a mutual fund where you have to wait till the end of the day to trade.
Exactly. With ETFs, you can move fast, which is really important in a market that moves fast too.
Okay, so we've got diversification, low costs, and flexibility. What else is there? I'm also seeing something about tax efficiency. But taxes always make my head spin.
No worries, I'll keep it simple. Basically, ETFs are structured in a way that can reduce your taxes compared to other investments.
Less taxes, that's a win. Now with all these advantages, they almost seem too good to be true. Are there any downsides we need to know about?
Well, like any investment, ETFs do come with risks. Their value is tied to whatever they hold, right? So if those assets go down, so will your ETF.
So no magic money machine, huh?
Not quite. You really got to research, understand what's in the ETF, its track record, the fees, do your homework.
Got it. Knowledge is power. Now, about the variety of ETFs out there, our source mentioned a bunch of different types, like choosing a flavor of ice cream.
It's a great analogy. There's an ETF for just about every strategy and every risk level. Let's start with the most basic, the index ETF.
Okay, back to basics. Tell me about index ETFs.
Well, they're designed to track a specific market index, like the S&P 500 we talked about earlier. It's a simple way to, to get a piece of the whole market without picking stocks yourself.
So it's like tasting the whole market in one scoop.
Exactly. And because they're just tracking the index, they usually have low expense ratios, too.
Low cost and broad market exposure. Seems like a good place to start. But what if I want to target specific investments? Like, say I'm really interested in renewable energy.
That's where sector ETFs come in. They focus on specific industries, like you said, tech, healthcare, clean energy, all sorts of things.
So if you have a hunch about a sector, you can ride that wave with a sector ETF.
You got it. You put your money where your beliefs are.
I like the strategy here. But what if I'm not about chasing the latest trends? I want something steady and reliable.
In that case, there are bond ETFs. They invest in a portfolio of bonds, which tend to be less volatile than stocks, and offer a more predictable income stream.
So bond ETFs are like the workhorse of your portfolio, just steady and reliable.
You can say that. They're good for people who prioritize stability.
Yeah.
Maybe those nearing retirement, or even just starting out and wanting a safer option.
Makes sense. But what if you're feeling adventurous? Want to invest outside the US?
Then you'd want international ETFs. They let you invest in companies in other countries. You can focus on specific countries, regions, even the whole global market.
So if I think Japan's market is going to take off, I can get an ETF that focuses on Japanese companies.
Exactly. A great way to diversify globally.
The possibilities. But wait, there's more, right? What about these thematic ETFs?
Right, those are interesting. Thematic ETFs let you invest in companies that are, part of a specific theme or trend, like AI, clean energy, even the metaverse.
Investing in the future. Straight out of a sci-fi movie.
It can feel like that.
Mhm.
It's a way to invest in the ideas you think will change the world.
So if I think self-driving cars are the future, there's an ETF for that.
Probably. And for those who want to invest in real estate, but without being a landlord, there are REIT ETFs.
REIT ETFs, I've never heard of those.
REIT stands for Real Estate Investment Trust. These ETFs invest in companies that own and operate real estate, things that generate income, like office buildings, shopping malls, apartments.
Like owning a tiny piece of a skyscraper, but no leaky faucets.
Exactly. They're a way to get into the real estate market without actually owning property.
This is blowing my mind. So many options. But let's get practical. How do I actually invest in an ETF?
It's easier than you think. First, you open a brokerage account.
A brokerage account, is that like a special bank account just for investing?
Pretty much, it lets you buy and sell investments, including ETFs. There are a lot of online platforms now, many with no trading fees, so it's pretty easy to get started.
The source mentioned Fidelity, Vanguard, Robinhood, Schwab. Like choosing your ETF supermarket.
Yeah, you can think of it like that. Each one has its pros and cons, so it's worth doing some research.
So I've opened my brokerage account. I'm ready for my ETF adventure. What's next? How do I choose which ETF to buy?
Now that's where the strategy comes in. Choosing the right ETF is all about matching it to your goals, risk tolerance, how long you plan to invest.
So if I'm saving for a house, I choose a different ETF than someone investing for retirement.
Exactly. And someone who's comfortable with risk might go for those thematic ETFs with cutting-edge tech. And someone who prefers a safer approach, they might stick with a broad market index ETF or a bond ETF.
It's all about finding the right ETF to match my circumstances.
Right. No one-size-fits-all approach. And remember, research is key. Before you buy, understand what's in it, how it's performed, the fees. Don't just jump in blindly.
Knowledge is power. Now, once I've chosen my ETFs, how do I invest? Do I just go all in at once?
There's a better way. It's called dollar cost averaging.
Dollar cost averaging sounds complicated.
It's really not. Instead of trying to time the market, you just invest a fixed amount regularly no matter what the market's doing. Like every month or quarter, I actually use this myself.
You do?
Yeah. Every month I put aside a certain amount for a few different ETFs. Sometimes the market's up, sometimes it's down, but I just keep investing.
So you don't try to predict the market?
Right. It all averages out over time.
Steady and consistent. But once I've set that up, am I done? Can I just forget about it?
Not completely. You want to check on your portfolio sometimes. Make sure your investments still match your goals. And you might need to rebalance things if one investment has grown more than others.
Rebalance.
Yeah. So let's say you started with 70% stocks, 30% bonds, but your stocks are doing great and your bonds haven't moved much. You might sell some stocks and buy more bonds to get back to that 70-30 split.
Keeping my ship on course.
Exactly. Regular monitoring and rebalancing will help you stay on track.
This is all making sense. ETFs sound really powerful. But before we finish this part of our deep dive, I have a question. The source mentioned mutual funds. How do they compare to ETFs?
They're definitely related, but there are key differences. Mutual funds are kind of like ETFs in that they pool money to buy assets. But ETFs are traded all day on the stock market. Mutual funds are priced and traded only once a day.
So that's what they mean by ETFs being more liquid.
Exactly. And ETFs usually have lower expense ratios too, which is a big difference over time.
Lower fees, more flexibility. Seems like ETFs are winning. Any other big differences?
Well, ETFs are usually more accessible for new investors. Many don't have a minimum investment, so you can buy just one share if you want. Mutual funds often have minimums that can be pretty high.
More democratic, then.
You could say that. And then there's the tax efficiency we talked about. ETFs tend to generate fewer taxes than mutual funds.
Wow, a lot of advantages for ETFs. Are there any times when a mutual fund is better?
Oh, sure. ETFs are more hands-off, but mutual funds are managed by professionals.
So if I don't want to pick my own investments, I can let the mutual fund manager do it for me.
Exactly. It depends on what you need, what you prefer, how you like to invest. ETFs are great for low-cost, flexible investing if you want to do it yourself. Mutual funds give you professional management if you prefer that.
So no clear winner, just different tools for different jobs.
Exactly. The key is knowing the differences and choosing what fits you best.
We've covered a lot in this deep dive. We explored ETFs, the different types, the advantages, how to get started, what's next.
We've got the basics down. Next, we'll get practical and look at some real-world examples of popular ETFs.
Okay, let's see how these things work in the real world. We'll be back soon to put our ETF knowledge to the test. Stay tuned.
Welcome back to the deep dive. So before we start talking about specific ETFs, we were just comparing them with mutual funds. And ETFs have a lot of advantages, but it's important to remember that there's no, one perfect solution for everyone when it comes to investing. The best strategy is always the one that's tailored to your own individual needs and goals.
Like trying to fit everyone into the same size shoes.
Haha, yeah, that's a good way to put it. Speaking of finding the right fit, let's dive into the world of ETF selection. It can be pretty exciting, but also a bit overwhelming, right? It's like walking into a huge library with books on every topic you can imagine. Where do you even begin?
Yeah, that's true. Too many choices can be, well, they can be paralyzing. Where do we start when there are thousands of ETFs out there?
The best place to start is always with your goals. What do you actually want to achieve with these investments? Are you, dreaming of early retirement, saving for a down payment, paying for your kids' education?
So before ETFs, we need to figure out where we're going.
Exactly. Let's say your goal is to retire early and travel the world. You might need a more aggressive approach to build wealth quickly. You might consider, portfolio with a lot of growth-oriented ETFs, like ones focused on technology, emerging markets, maybe innovative healthcare solutions.
But those thematic ETFs we talked about before.
Precisely. Those have the potential for higher returns, but they also come with more risk. It's like climbing a mountain. The higher you go, the better the view, but the farther you can fall.
Okay, high growth, high risk. Makes sense. But what if someone wants to preserve their wealth and get a steady income? Maybe they're closer to
In
retirement.
that case, you want a more conservative approach. You'd focus on ETFs that are all about stability and generating income.
Hmm?
Bond ETFs are good for that. Also, dividend-paying stock ETFs.
Dividend-paying stock ETFs.
Yes. So it's like owning part of a company that pays you a share of their profits just for being an owner. That's what dividend-paying stocks do. And you can get a basket of these companies through an ETF.
Like getting a paycheck from your investments.
Yeah, kinda. But remember, every investment has trade-offs. Dividend-paying ETFs give you steady income, but their growth might be slower compared to those high-growth ETFs. It's all about finding that balance for you.
Trade-offs. Finding the sweet spot. Speaking of risk, how do you figure out your own risk tolerance?
It's definitely personal. It's really just about how comfortable you are with the market going up and down. How much uncertainty can you handle without losing sleep? It's influenced by things like your age, your finances, your experience with investing.
So someone in their 20s can handle more risk than someone who's about to retire.
Right. Younger investors have more time to recover, so they might be okay with those high-growth, high-volatility ETFs.
Yeah.
Someone nearing retirement might want to preserve their capital and be more conservative.
Like choosing between a roller coaster and a Ferris wheel.
Perfect analogy. And since we're talking about time, don't forget about your time horizon. How long are you planning to hold these investments? Years? Decades? Or do you need the money soon?
So if I'm investing for retirement, I can be patient and let things grow.
Exactly. Long-term investors can focus on growth, even if there are some ups and downs along the way. But if you're saving for something short-term, like a down payment in a few years, you might want ETFs that are less likely to change in value a lot.
Okay, so goals, risk tolerance, and time horizon. The three things to think about before investing in ETFs.
Exactly, like building a house. Goals are the blueprint, risk tolerance is the foundation, and time horizon is your timeline.
I like that. But choosing from thousands of ETFs still seems hard. How do we narrow it down?
Research, due diligence. Thankfully, there's a lot of information out there. Websites like ETF Database and Morningstar have these great tools called ETF screeners.
ETF screeners.
Yeah, so they let you filter ETFs based on all sorts of things, like what assets they hold, the sector they focus on, the geographic region, the expense ratios, their past performance.
So I can basically create my own list of ETFs.
Exactly. You can set the filters to show only ETFs with low fees, or ones that focus on, say, clean energy or AI, whatever you're interested in.
Okay, that makes it more manageable. But even with a smaller list, how do I pick the winners?
That's where you really got to dig in. Here are some key things to focus on.
Okay, I'm ready.
First, look at the ETF's investment objective and strategy. It's like their mission statement. What are they trying to do? How do they plan to do it?
So if I want growth, I shouldn't pick an ETF that's focused on income.
Right. You want to make sure the ETF's objective matches your own goals.
Makes sense. What else?
Next, look at the ETF's holdings. What's actually in it? What are the specific things it invests in?
Anything specific to look for there?
Well, if you want diversification, you don't want an ETF that's only invested in a few companies. You want a wide range of holdings across different industries, maybe different countries.
Diversification within the ETFs themselves. Got it. What about performance? How do I know if an ETF has been successful?
You can look at its past performance data. Most financial websites will have that. Now remember, past performance doesn't guarantee future results, but it can give you some idea of how the ETF has handled different situations.
So it's a clue, but not a guarantee.
Right.
Okay, anything else?
Don't forget the expense ratio. That annual fee the ETF charges, the lower the better.
Right, less fees, more money for me.
Exactly. And finally, consider the ETF's liquidity. How easy is it to buy and sell shares? Most ETFs are pretty liquid, but some are better than others. You can check the average daily trading volume to get an idea.
A higher volume means it's easier to buy and sell.
Exactly. If you think you might need to sell quickly, liquidity is important.
Okay, so much good information here. Goals, risk tolerance, time horizon, and then all these things to consider when evaluating a specific ETF. But making the final decision still feels, well, a little scary.
I get it. Just remember, investing is a marathon, not a sprint. Don't rush into anything. Take your time, do your research, and choose what's right for you.
Slow and steady wins the race.
Exactly. And don't be afraid to ask for help. There are financial advisors who can help you.
Great advice. Investing can be intimidating, but with the right knowledge and some patience, it can be a great experience. We'll be back in a minute to look at some popular ETFs and how they fit into different strategies. Stay tuned. All right, welcome back to the deep dive. Let's look at some real-world examples of ETFs now.
Sounds good. It's time to see how these things work in practice.
Let's start with that classic one you mentioned before. What was it? The big one.
You mean the Vanguard S&P 500 ETF,
Hmm.
ticker symbol VOO. It tracks the S&P 500 index, which is, 500 of the largest U.S. companies.
So with VOO, I'm basically investing in the whole U.S. stock market at once.
Exactly. It's a great option for long-term investors who want broad exposure. Plus, it has a low expense ratio and a good track record.
Solid foundation for any portfolio. What other ETFs should we be looking at?
Well, let's say you're interested in tech. There's the Technology Select Sector SPDR Fund, ticker symbol XLK. It holds stocks from the technology sector of the S&P 500.
So instead of picking individual tech companies, I can invest in the whole sector.
Exactly. You get exposure to all the big names. Just remember, tech can be volatile. This one's for investors who can handle some ups and downs.
Got it. High growth, but maybe a little risky. What about those investors who want steady income and less risk?
For them, there's the iShares Core U.S. Aggregate Bond ETF, ticker AG. It tracks a wide range of U.S. bonds, government bonds, corporate bonds, mortgage-backed securities.
So it's like a bond mix.
Exactly. A good choice for reducing risk and getting that steady income.
Okay, we've covered some basic categories. Now, what about those thematic ETFs we talked about, the ones that focus on future trends?
Those are exciting, for
Yeah.
sure. One popular one is the ARK Innovation ETF, ticker ARKK. It invests in companies that are doing, disruptive innovation. Things like AI, robotics, genomics.
Investing in the future.
Exactly.
Huh.
ARK has done really well, but it's high risk, high reward.
Not for everyone, but definitely appealing for some. Any other thematic ETFs that tap into those big trends?
If you like clean energy, check out the Invesco Solar ETF, ticker TAN. It tracks global solar energy companies.
So as the world moves towards renewable energy, TAN lets me invest in that.
That's the idea. It holds a bunch of solar companies, from those making the panels to those installing them.
Amazing. You can really align your investments with your beliefs.
Exactly. Put your money where your heart is.
We've only just scratched the surface of the ETF world.
That's true, but these examples give you a good starting point.
So for a new investor, where do they begin?
Remember those three things we talked about: your goals, your risk tolerance, your time horizon. Figure those out first, then research ETFs that match.
And remember, it's a journey.
That's right. Start small, learn as you go, and adjust your strategy if you need to.
Great advice.
The more you know about ETFs, the better decisions you can make.
That wraps up our deep dive into ETFs. We hope you've enjoyed learning about them and that you're feeling ready to take control of your financial future.
Remember, the most important investment is in your own knowledge. Keep learning, keep exploring, and you might just find your own perfect ETFs along the way.
Thanks for joining us on the deep dive, and happy investing!